It's time for the Phil Ferguson Show.
Well, hello there. This is Phil Ferguson, and you are listening to the cleverly titled The Phil Ferguson Show. Fun show today, 3 different topics. I think you're going to like all 3 of them. Some are kind of a follow-up on topics previously discussed, and one of those is, for example, TIPS, Treasury Inflation Protected Securities. I had mentioned them before and how you could go buy them. And this time I'm going to talk a little bit more about the risks that they impose because like everything in the world, when someone has something to sell to you, they're more likely to point out the good things and skip the bad things. So that segment is going to be about some of the bad things, some of the problems and or risks with owning TIPS. Another thing is an economic point as a discussion of unemployment and I think it's called the labor force participation rate. I always call it workforce participation rate, but I think it's the labor force participation rate and unemployment in the mix. And where did all the workers go? And in that segment, I'm going to talk about some possible ideas and explanations for where the workers went. And I think the key takeaway is that it's probably complicated. It's not an easy answer. Anyone who says it's just because the government gave people $300 a week to be unemployed and therefore they don't want to work is profoundly wrongly oversimplified. So we'll just go with that. And then the last one is something I just recorded because I just got an email on a concept called return stacking. And I couldn't actually see the original article that the listener sent to me, but I did a little research and I'm going to go over that in that segment. And of course, the idea of return stacking is that by being clever and smart and with using alternative assets and some leveraging, you can actually make more than the market while reducing your risk. You will not be surprised to hear my opinions and thoughts on it. And I actually found some data to back up what I'm talking about. So that's all coming up a little later. So I'm going to wrap up the opening intro thingy here. We'll take a couple of little breaks and we'll have some fun learning more about investment-y stuff.
Never felt the slightest interest in the next world. I think it's here, and I think anything good that you're going to do, you should do for other people here and not do anything to make yourself have a happy time in the next world, you know. No, I don't believe in religion. If you can live for other people away from yourself, you will be happy. And if you live for yourself, you will be unhappy, and you will then not be able to sleep or do anything else. After all, we have no notion as to what the next world is, if there is one. Mm-hmm. So there's no point in that. But it's always been, I hear a lot of people saying, well, I don't know the difference between good and bad. I know totally, for myself, the difference between right and wrong. Totally. Uh-huh. I know this because wrong makes me very uncomfortable and right makes me very happy. And I don't think it's so very difficult to know when you're doing the right thing and when you're doing the wrong thing. And I think each person, the right thing, the wrong thing varies.
This is a little update on TIPS, T-I-P-S, Treasury Inflation Protected Securities. I covered these a few shows back as a possible way for you to hedge against inflation. And I'm not going to recover the basics of how a TIPS works. Well, maybe just a little bit in case you missed that segment. Treasury Inflation Protected Security. Basically, you buy a bond from the United States government. and if inflation goes up 3%, they will increase the face value of the bond by 3%. So if you buy a $1,000 bond and inflation is 3%, at the end of the year, the bond is now worth $1,030, an additional 3%. The interest rate paid on the bond doesn't change, but the face value changes. So if you hold the bond to maturity, you will get $1,030. I've gotten quite a few emails on that, and tips are now very, very hot and trendy kind of thing. And I'm getting emails from people wanting me to sell tips to everybody. And I'm also getting emails from listeners, and I've even talked to a few clients saying, Phil, why aren't you using more tips? And I thought, why am I not? And I went and re-reviewed my thoughts on this and re-examined it. The short answer, I'm not changing my position. I'm not loading up on tips. If you want to buy some tips directly, you can go do so. And that was discussed in that previous episode. But I want to make sure I go over some of the downsides of tips, because they can and do protect you from inflation if there is inflation. But I'm actually looking at a Wall Street Journal article, which might be behind a paywall for you. It's called Don't Believe the Inflated Yields on Inflation-Protected Bond Funds by Jason Zweig, Z-W-E-I-G. This is from July 16th. It's, a couple months old, but the idea still stands. And some mutual fund companies are reporting that inflation-protected bonds of all different types, domestic or foreign, are having yields of 8%. 8%. Yield of 8%. How the fuck is that possible? It's a trick. Everything's a trick. It's a fucking game. Why everything has to be a fucking game? The SEC did not create clear rules about how someone must calculate the yield on Treasury inflation-protected securities. Now, Vanguard, as a beacon of integrity and honesty, yay, I've talked about some things they've done lately that I don't like. This is something that they've done that I do like, and I am looking at their Treasury inflation-protected security fund right here, the Admiral shares, which is VAIPX. I suggest that if you really want tips, that you should buy them directly. But if you want to be lazy, or if you want to get more of them, you can do that through this fund. Again, VAIPX. The minimum initial investment is $50,000. If you really want to do this, I'm thinking 5, maybe 10% of your bond portfolio. And here are some of the reasons. And one of the things I like about Vanguard and the way they display this, Vanguard is saying that the current yield on these funds is minus 1.74%. And how is Vanguard reporting minus 1.74%, almost minus 2, while other organizations are reporting 8% plus? It's a math trick. It's a math trick. Every 30 days, one can take the consumer inflation price index, whatever it is, and calculate how much more the yield would be if that were to continue. And mutual fund companies only have to give you refreshed, up-to-date data, I think, once a quarter. Maybe it's once every 6 months, but let's just say it's once a quarter. So they don't have to reprint documents every week or two or even every month. They can use a couple of month-old data. It's still considered relevant. But if there is a specific month where inflation is high that month, so let's say we have 0.2% or 0.1% or 0.15%, and then we have a month that's 0.9%. They'll grab that 0.9%, and because of the SEC rules, they are allowed to assume that inflation is now 0.9% for the next consecutive 11 months, for a total of 12 months. That's right, a number that jumps up and down quite a bit month to month and often gets readjusted a month or 2 or 3 later, they are allowed to take any 1 month out of 2 or 3 months and say that's the date we're using. It's factually correct. It's technically correct. It's mathematically correct. Boy. At best, it's misleading. At worst, it's dishonest and deceitful. So what they do then is, if the inflation is 0.9% for 1 month, of course, 10 months would be 9% inflation, plus another 0.9, plus another 0.9. So you have 9.9, 10.8% inflation minus the current actual yield on the bonds of minus almost 2%. So that's how you get to something of 11 minus 2 is around 9 or a little bit below, depending on the exact numbers that you're using. And these fund companies are able to put in their documents that these funds are yielding 8% plus. That could be true if inflation is 0.9% per month for the next 12 consecutive months after you buy them. I don't expect inflation to be 12%. If you do expect inflation to be 12%, you should be buying this shit up like fucking candy. So it's just what you think. Now, the problem is that if you bought a TIP, Treasury Inflation Protected Security, at face value, let's say $1,000, if inflation does not go up, you will get back when you sell it, when it is redeemed after a certain number of years, you will get back your $1,000 minus the 1.74% interest. So if inflation does not go up at least 2% based on the current yield, you will actually lose money. And so how much of a hedge against inflation do you want? Because if you can just buy a short-term bond fund that pays close to 1%, okay, so that's kind of like your no-risk scenario. If you buy a bond instead that's paying minus 2%, inflation has to go up 3% or more for you to break even with that stupid, boring, safe bond fund. What do you think it's going to do? Now, I'm going to add an additional twist, because if you buy TIPS directly from the government, you will pay face value, $1,000. And they have different maturity dates. And they can be, I think it's 5, 10, 15. I'm going to check right now in real time. Here we go. On the Vanguard website, the duration on this fund is 7.8 years. The average age to maturity is 8.2 years. It is not going to be affected by interest rate fluctuations anywhere near as much as a regular high quality bond might be that has a duration or a maturity of around 8. We've talked about that before. But what can happen to these bonds is that the face value changes based on inflation. So again, if you bought it for $1,000 and let's say it pays minus 2% at the end of the year of inflation, in this case, let's say 5%, the face value changes to $1,050 and the minus 2% is paid on a larger amount. That's a bigger loss, isn't it? But if there is inflation, that number will be bigger and you'll do okay. The bond is theoretically worth more and the interest that it pays is more if it's positive at all. Wow, I hadn't even thought about that before doing this in real time in my head. However, that bond that has a face value of $1,050, there is nothing preventing you from selling that at a higher price. Say someone is really concerned about inflation and they want to get more Treasury inflation protected securities than they can buy directly from the government, and they go on the market to buy them. So if the demand is high, they might come to you and say, hey, look, I know the face value is $1,050. I'll give you $1,100 because I'm super concerned that inflation is going to go up. And if you believe that these will keep getting adjusted up in face value over time, you might be able to buy like a 3 or 4 year old TIP for maybe $1,200 $200, something like that. If inflation does not occur and you paid $1,200 for the bond, but its face value is $1,100, you could lose $100 or almost 10% when you go to sell it, because it's not really worth that much because it doesn't have a face value on it. So not only do you have a negative yield baked in the cake of almost minus 2%, you might have a situation today where people are more worried about inflation than they should be. Maybe they're right. If they're right, they're going to be fine. If inflation is worse than they think, they're going to do really well with these things. But if they're wrong and inflation comes down and stabilizes back to 2, 3, 4, 5% like we normally would expect, normally it's 3% or less, tips that have been inflated in valuation by purchase price increases, they might fall back to the amount that's equal to the face value. There is also the possibility that if the pandemic comes to an end, and maybe it does, if most things kind of get back to work and people get back to jobs, and we not only don't have inflation, but we have deflation, the face value of the bonds that you bought can be adjusted down by the government. Tips go up and tips can go down. So if you have a Treasury inflation protected security that has a face value of $1,100 and inflation is minus 2% for a year, nothing crazy. We're not going to worry about a deflation problem with our economy or anything, but just say for 1 year it goes down 2%. Well, now $20 will come off the face value of that bond. And so now when you want to sell it, not only have you lost value of the bond, maybe nobody wants to buy it from you. And it's okay if you hold it to maturity, you're going to get the face value back from the government unless it goes down some more. And so like any other bond, the longer the bond is, if you get a 10-year or 20-year bond instead of a 5-year bond, you're taking on more risks because there's more time for things to get interesting. So keep in mind that the numbers that you're seeing of 8% are being put out by companies that, while technically allowed and not illegal, the numbers that they're showing you, I think they are being dishonest and possibly, deceitful at least, and possibly dishonest. The current yield is about minus 2%. If inflation stays high, the value of the bonds can increase such to a point that the increased value of the bond offsets the negative interest rate that you're going to get. But if people have jacked up the prices and you buy in now while everyone else knows about this and everyone else wants these things, you could end up overpaying, whether you're buying individual tips on the open market or if you're buying a mutual fund that goes out and buys these tips. Because if the average yield is minus 2%, if average inflation is 3%, Phil would expect that in the long run, you're going to make about 1%. So the thing that you want to look for, and I think they have it here at Vanguard. This is a real nice one. We've talked about this before. Yes, yield to maturity. Yield to maturity is very easy to find for any bond investment that you want to buy. And yield to maturity gives you an approximate number that you should expect if you buy that investment. So most bonds, if for example, if you buy a 5-year bond that has a 2% dividend, if nothing happens, nothing good, nothing bad, no changes in interest rates, no supply and demand weirdness, the yield to maturity is 2% because that's what the yield is. You get 2%, you get 2%, you get 2% for 5 years in a row. If that's what happens, your yield to maturity will end up being exactly 2% as expected because that was the yield of the bond that you bought. If you buy it, hold it to maturity, or even if you buy it and sell it or sell it and buy it, as long as there's no other factors, there always is, by the way, but as long as there's no other factors, the yield to maturity on a 2% bond is 2%. The currently expected yield to maturity from the Vanguard Mutual Fund of TIPS is 0.9%. I'm going to call it 1%, which is about the exact same fucking return as the short-term treasury or short-term corporate bond funds, about 1%. So it's a hedge against inflation, but if you end up buying into a fund that has overvalued bonds and inflation doesn't materialize, or people no longer want to hedge against inflation, or at least they don't want to hedge as much as they have been hedging against inflation, you could lose money on this fund, not just because it pays negative 2% in yield, but its actual face value could go down so that when they get sold, they're sold for less than what the fund or you as an individual paid for them. So you could have negative interest and negative price appreciation, all while, as you thought, you were protecting yourself, and you were, from the risk of inflation. So it's complicated. Is it a good thing to get? Maybe, maybe not. That's why I wouldn't get carried away with it. So if you've got the idea, hey, I'm going to take 100% of my bonds and buy TIPS because I'm covered. And that's what I want the bonds for. I want the bonds for safety. I'm going to be covered. And if inflation's 10%, I'm going to make 10%. Well, if inflation's 10%, you might make 8%. Of course, if inflation is high and then it stops being high and you didn't sell the bonds yet, you might not even make the 8 or 10%. You might make 3 or 4%. So like everything else, it's fucking complicated. You need to understand what you're buying. If most of this didn't make any sense to you, fine. Don't buy TIPS. You don't have to buy TIPS. You can buy really boring index bond funds. You can get them from Vanguard. I've talked about some of the names before. I'm not going to go over now because, again, I'm getting almost to 20 minutes on this. But buy a really boring short-term government, almost equally as boring, but pays a teeny bit more. Short-term corporate bond fund. There's several to choose from at Vanguard or Fidelity or whatever. Look for something with incredibly low expenses and check the duration. You can also look at the average maturity rating. It'll be really close to duration, but duration is the more precise measurement, I think, to tell you what might happen if interest rates change. And try to find something, a fund that has incredibly low expenses and an average maturity or a duration below 5. And you can expect to get something really close to what the current yield is, which might be 0.5% or 1%. But the purpose for the bulk of that money in the cushion, it's not to make a big pile of money. It's to not lose money in case the stock market goes down 30%, so that you can have more money in the stock market making larger average returns, theoretically, while protecting a portion of your money that you can take out if the market goes down. So some information on TIPS. Hopefully that helps somebody. We'll get on to another part of the show. The Phil Ferguson Show is for educational purposes only. Nothing said on the show should be interpreted as personalized investment advice. Your investments should be based on your situation, and you should consult with your financial advisor before taking any action. The show may contain ads. These ads are placed into the show by the hosting company after I finish recording and editing. I have little control over the content of the ads, and you should not assume that I support their products or claims. If you choose to support the show via the new Patreon page, that support does not create an advisor-client relationship.
You're listening to The Phil Ferguson Show.
Let's talk unemployment, can we? Just for a few minutes. Before I get too far into this, a special thank you to my wife, Robin, who pushed me a little bit in this direction, asked me great questions, helped me think about what I might want to say and discuss, and just general conversation about the topics mentioned in this specific segment. And of course, just for being an awesome wife who puts up with my craziness, whatever we want to call it. So we're going to get technical. And part of this is also inspired by quite a few emails from listeners. And I think it's because I just kind of threw out there recently that question of, where did all the workers go? Why does there seem to be a shortage of employees? Well, that's a great question. And one of the things that is often thrown at me by relatives and non-relatives, people on different platforms. It's because the government is paying people to stay unemployed. Well, U.S. unemployment funding has a long and noble history of helping people out that have lost their jobs, and that's not materially different. During the pandemic, when it was believed that, and I think rightly, by the way, that it was harder to find a job because of contractions in the economy, helping people out a little bit so that they didn't go hungry and had money to spend, which helps keep the economy going, was the right thing to do. And people say, well, that extra $300 stopped people from going back to work. And I don't know about you, but if you decide that $300 is worth more than working, maybe your working isn't paying you enough. I'm just going to throw that out there. Now, if you're in a small town America, $300, okay, maybe that makes all the difference because prices can be really affordable for things in small town America. But if you're in a big city, which interestingly, the vast majority of Americans are, that's why they're big cities, $300 is not really going to cut it. So I didn't think that was a big driver. And I think we have a nice little subset of data because we have states that are red states and some states that are blue states. Most states are genuinely purple, but states that cut the additional unemployment benefits earlier don't seem to be doing any better at getting more people to work. Not that we necessarily need to get more people to work. And that's a whole nother topic. But one of the things I want to talk about is the labor force participation rate, also called the workforce participation rate. And like any number, it's a number. It's interesting. It might be helpful to help frame how you think about things, but often it's like any number, thrown out in a post, in a comment, cited on the news as an example of the impending doom. Whether it's from conservatives telling you how bad Biden has made everything, or if it's from liberals telling you how awful Trump was and still is awful, just so we're clear there. But the workforce participation rate, this is a description of the percentage of the population over the age of 16 that are eligible to work, as defined by having, I think, the physical and mental capacity of being capable of working. So if you have saved up a whole bunch of money and don't want to work, you could work. There's nothing preventing you from being able to work, and you're over the age of 16. One can think about all kinds of things that affect this. How is employment opportunities for 17 and 18-year-olds? How many people have made good money in the stock market in the last few years of their lives and have decided, hey, I did lose my job from COVID, but because the market's done so well since '08, I've made pretty good money, and maybe it's not the exact dollar amount that I wanted, but I don't want to fuck around with finding a new job again. And so I'm just calling it. I'm retiring a year or two early. Maybe there's people like that. Maybe there are people who've moved. Maybe more members of a family, instead of living in 2 or 3 different places, now live in one place, which may not be optimal, mind you. But I'm just trying to think out loud of things that can affect this. If you have multiple family members living in one apartment because they can't afford their rent, which would definitely be I think a negative sign of the times, but that's the way they get by. Somebody might have to stay home to watch all the kids because all of the daycare centers are having a hard time hiring people because there's less employees. But then this person is now not working for a pay for a job because they're at home taking care of several family members, several kids, maybe even adults, who knows? And so they're available to work. They're capable of working, but they're not working. Back in, just ideas. I may not be right. I may not know any of these. It's just some thoughts about it. back in the 50s and 60s and 70s, when this number was first created, the percentage of the population that was working, the labor force participation rate, was 58, 59, 60%. And from, 73, 72, it started a gradual upward trend. It bounces around a little bit, but it's not that volatile. And it peaked in, let's see, what is this, around 2000. I guess not too big of a surprise there, around 67%. And then it fell a little bit in 2000, 2002, around 08. It started this interesting trend where it went from 66 down to about 63 in 5 or 6 years. And then it really kind of got to 63, give or take 63%. Well, when COVID hit, February, March, April of last year, it fell from 63.5% down to about 60%. Now, it's only a 3.5% change, you might say. But out of 300 million people that could work, that's now suddenly, actually wouldn't even be 300, yeah, it'd be about 300 million. Everyone over the age of 16 who can and is capable of working. A 3% drop, give or take, is 9 million people that are now not working. And one would think once COVID is over, it's not really even completely over, it would bounce back. But it bounced up to 61.4, 61.6, 61.7, not 63 plus. So it's still 1.5% of people who are able to work are not working. And again, out of context, this number can be thrown out as proof of a good thing or proof of a bad thing, depending on your perspective. I'm trying to not do that so much, but consider, is there a shift? Is there a possibility that 9 million people aren't working for some reason? And what is that reason? Is it because they are forced to stay home to take care of their children? Is it because they now have a shared residence, and now that there's more family members in an apartment because somebody wasn't able to pay their mortgage or rent, that they now can actually, kind of in a weird way, because they're not independently living with a family member, they don't have to work? Is it because somebody that is working in the family got a big pay increase because of an increase or a decrease in the supply of labor, that it's a little harder for employers to get new employees, so they gave some people pay raises? And if you have a husband and wife, or a husband, wife situation, 2 people, it could be 3, could be 5, whatever, people living together, if someone gets a big pay increase, and it might be a little bit easier for the other person or one of the other people to not work. So maybe that's it. I earlier on mentioned the idea of someone who loses their job and they were only a year or 2 out from retirement and said, hey, you know what? Fuck it. I'm just done. I have enough. It's not the number I wanted, but I'll get by. Well, which one is it? Or is it all of these combined? Or is it something else? I don't know. I don't think there's a change in the way the number is calculated, but just throwing out the number without considering at least what is causing this is interesting. And of course, when labor is tight, a lot of people have now the power to negotiate or to insist or to haggle or to move jobs. I think I saw something where we had a record number of people that quit jobs in the last month or the last quarter, just voluntarily quit. And people voluntarily quit when they think or know that they have a better job lined up, or they think they can easily get a better job. And maybe that's the case right now. And so the jobs that don't go filled are often the jobs that nobody really wants. I mean, there are people who make a fine living, and I'm delighted that they do it. They drive hazardous chemicals around in a truck, or gasoline, which I use very little of now. Thank you very much. Or work at a fast food restaurant where the pay is not great, and particularly if you're short-staffed and people get cranky at the drive-through because the room is not even open. It can be a tough job, and the pay may never be enough for you to just say, fuck this, I'm going to go do something else. especially if you're not respected and treated as a valuable member of the team. And of course, whenever someone says to me, just carte blanche, a business owner, no one wants to work nowadays. Okay, fuck you. I'm sorry. The people who can afford to not work, good on them. However that came by, hopefully it's a good thing. They can afford to not work. But the people that leave your employment because they found a better job, you got to own some of that. So don't just tell me that it's other people who don't want to work. And if you are an employer or manager or owner of a company, and you are hiring people that make 1/100th of what you make, you may be a big part of the problem. Just something for you to think about. I have no problem with people making a lot of money, especially if they have a very successful business. But you need to understand and respect that you didn't do it alone. You have a lot of people helping you out, making things, providing value to your company. Are you being fair with that? Or are you being like a dragon hoarding gold? How many billions does one person need? Spread the wealth around, motherfucker. Okay, sorry. Sidebar. So that's the workforce participation rate. It is lower than it was before the pandemic. Why? I don't know. But it's just something interesting to talk about. And I wanted to kind of go over the nuance of this number. And again, sorry, the official name is the labor force participation rate. I often call it the workforce participation rate. And this might be brought up. I've seen it in more articles. I've seen people ask me about it. Now, the other thing that's interesting is that we just had a new jobs report from the Bureau of Labor Statistics, and you can fucking Google this, people. And I Googled it, and the very first hit was from them. It's the news release that came out just a couple of days ago. 41 fucking pages of data, graphs, and charts, and tables, and explanations for what all the numbers mean. That's fantastic. But what tends to happen in our high-paced society is that either in a Facebook post or on a serious local news channel or a network news channel, they just throw out one number. And the one number that everybody's throwing out is 4.8. 4.8. But the other number they're throwing out is 194,000. So the number of expected jobs by the average economist was something like $400,000 or $500,000 for the month of September. It was 194,000. So it's a lower number compared to many of the recent months. And that is the number of people that have found a new job or have added a job. I think it's a net number, people that lost jobs versus added jobs. So a positive number is nice. We still don't have as many people working as we did before the pandemic. And part of that can be seen in the workforce participation rate. So that's interesting. But the unemployment rate fell to 4.8. So it went down, which is generally considered a good sign. And so the news and the conspiracy people go out there and scream that, well, if only 194,000 jobs were created, how can the unemployment rate go down? That's a good question. But they're not asking it as a question with the intent of a serious inquiry and coming to an understanding of what this number means. They're just throwing it out there as a conspiracy. Oh my God, you can't trust the government. And maybe you can't. But you know what? If you can't trust the government, then don't even talk about these numbers because you can't trust the government. So I don't even know why you're having a discussion. But unemployment is kind of tricky. And so I went through this document, and of course I was delighted to find this without having to go somewhere else. On page 28, it goes over, household data, table A-15, alternative measures of labor underutilization. Okay, that's a lot of fancy words, but basically this is how they measure, or the data that they've measured of unemployment. First thing I got to cover, very, very important to understand, they report 6 different numbers every month. There's 6 different ways to calculate unemployment. They are formally known as U1, U2, U3, U4, U5, and not surprisingly, U6. So, U3 is the official methodology that has been used since, I think, the early 70s. So if anyone is quoting the unemployment rate, one would expect, as I do expect, that they're reporting U3. And this is the quick note that they have here is total unemployed as a percentage of the civilian labor force. So you have the total unemployed and you have the civilian labor force. If the labor force is smaller and the number of people that are looking for work stays the same, or the number that are unemployed stays the same, then the unemployment rate could go up. If the population is going up or going down, it can change the number. If the number employed goes up or goes down, it can change the number because it's a calculated number. The other important part is total unemployed. Well, what does it mean by unemployed? So you have to dig into it. For the U3, it's people who are unemployed and actively looking for work. If you give up and you quit, and I don't mean quit your current job, but you just quit looking. You say, fuck it. I don't need this money. I don't need to deal with the job. And maybe that is a sign that you're totally disconnected from reality. Maybe it's a sign that you have a nice position where someone around you that cares for you is making enough money that you don't have to work. If you're one of those people, pro or con, whatever, if you stop looking, you're no longer going to count in the category of U3, the standard unemployment rate, which for September of 2021 is 4.8. Now, sometimes people come out and say, particularly if they have a political agenda, and they'll say, well, the real unemployment number is 8 or 9 or 12. And this happened a lot with when Obama was president. A lot of conservatives would say, well, the real unemployment number is not 8%, it's 20%. And you go, where are you getting that from? And they go, I got it from this website. And you go look at that website and it says the real unemployment number is. So, personal pet peeve, if you are not using U3, which is the number and the methodology that's been used since the 70s to quote unemployment, I don't think you can call any other number the real unemployment rate. U1 through U6 are all real measures, calculations, but it's understood everyone has always used and still to today uses U3. If you use U1 or U4 or U6, I think you have an obligation to point that out. Otherwise, at best, you're accidentally misleading. At worst, you're being manipulative. U6 includes all people. Let me just read it here. Total unemployed plus all persons marginally attached to the labor force plus total employed part-time for economic reasons as a percentage of the civilian labor force plus all persons marginally attached to the labor force. I think that's redundant, but the gist of U6, because I've gone over this before, it's been a while, but U6 includes people that are working and they're working in a job that they don't want to be working in. Okay, that's kind of a generic description, and a lot of people don't have the job. But I mean, like seriously underemployed. They're working, and they're making money, so they're not technically unemployed, but it's not the job they want. And it's not even close to the job that they want. It's like someone was a software engineer, and now they're flipping burgers. They're employed, but they're underemployed. It also includes people that are working, but only a fraction of the time, or in this case, part-time, for what they need or what they want to do. So they're employed, they're not fully employed. And the U6 currently is 8.5. So if someone or a news article talks about unemployment and they say 4.8, that's probably the conventional, historically used U3, the official unemployment rate as defined by the Bureau of Labor Management, which is the organization of the government that makes these numbers, calculates these numbers. If you hear someone talk about unemployment in September being 8.5 or saying real unemployment is 8.5 or whatever, they're probably using U6. And so if you come and say that's not unemployment, they could dig up a document like this and say, yes, it is. It's U6. Okay. I wasn't talking about U6. I'm talking about U3. And so we have this situation where the unemployment number U3 is 4.8. That's pretty good. That's about as low as U3 gets within a couple tenths of a percentage point or so. But yet there still aren't people working. And that, again, goes back to the labor force participation rate. So clearly, for some reason, or reasons, because it's probably really complicated, we have people who have chosen or been forced to, or their life situation has made it available to them to not work. Do we want to change that? Should we change that? I don't know. I mean, if someone has retired a couple years early because the market's been great to them for 10 years, do you want to take away their money or make them work? If a family has someone who is working that makes more money than they used to and the other person doesn't need to work, do we want to compel them to go to work? I don't know. Just something to think about. I guess I'll just wrap it up there because it went way longer than I expected. But it's kind of fun to think about these numbers and what they really mean. And like I said, if you want to look up this document, it's a Bureau of Labor Statistics, and this is the unemployment situation September 2021. It's a real easy Google thing. The one I have here is 41 pages. You can really spend a lot of time digging through this and trying to understand, and it breaks things down in dozens and dozens of different ways. And it might be interesting and give you a little bit more understanding of the nuance behind these numbers, because just simply throwing out 4.8% or 8.5% as the unemployment rate doesn't give you a whole lot of substance behind it. And this might help you understand how unemployment is calculated, how the unemployment rate is calculated, what workforce participation or labor force participation rate is, and how it's potentially useful or confusing. And so I hope that helped. If you have more questions about unemployment or any other economic topic, let me know. You can send me an email, phil@PolarisFinancialPlanning.com. We'll take a quick break and go on to some more stuff.
What if you're wrong?
Well, what if I'm wrong? I mean, anybody could be wrong. We could all be wrong about the flying spaghetti monster and the pink unicorn and the flying teapot. You happen to have been brought up, I would presume, in the Christian faith. You know what it's like not to believe in a particular faith because you're not a Muslim, you're not a Hindu. Why aren't you a Hindu? Because you happen to have been brought up in America, not in India. If you've been brought up in India, you'd be a Hindu. If you were brought up in Denmark in the time of the Vikings, you'd be believing in Wotan and Thor. If you were brought up in classical Greece, you'd be believing in Zeus. If you were brought up in Central Africa, you'd be believing in the great Juju up the mountain. I mean, there's no particular reason to pick on the Judeo-Christian God in which, by the sheerest accident, you happen to have been brought up, and ask me the question, what if I'm wrong? What if you're wrong about the great Juju at the bottom of the sea?
You're listening to The Phil Ferguson Show.
This little segment is on a topic called return stacking. Never heard of it before. Never. Genuinely, I'm not being a smartass. I know it's rare, but someone just emailed me and wanted to see what I thought about an article in the Wall Street Journal, I think it was. But it was behind a paywall, and I'm sure I could find a way to work around it, but I didn't care enough. So I just Googled this concept, return stacking, and found several different websites. The funny thing is that every single website uses the same infographics, and they all are using a lot of the same verbiage. It's almost like they're quoting each other. And it kind of gave me the feel of someone going out and making a whole bunch of websites and mixing and stirring the little bits that they have to make it look like they're different websites. So that's not cool. I don't like that. But, I did pull up some numbers for you just for laughs. But before I get into the numbers that I found, I wanted to read from one of the websites that seems to be, I don't know, one of the boss websites, the source of some of this stuff. Resolve Asset Management. I don't know anything about what they do at all. I don't know that I want to know anything about what they do. Interestingly, they're based in Canada, so I don't know how that affects U.S. laws, because the other websites gave different addresses and phone numbers, but maybe they're unconnected, but I don't know. So they're talking about the value, the benefit of return stacking. And I'm just going to read you a couple of these quotes. Stretched valuations in equities and fixed income imply depressed returns and higher potential volatility for traditional portfolios. So, end quote. So this is basically saying stocks are really high, maybe they are. Bonds are paying very little, which they are. Unless you take on some kind of bond risk, you're not going to make much. And that's true. Okay, next point. Pardon me. Next point. Reaching for yield or increasing exposure to pro-cyclical assets may help compensate for low expected returns, but can increase portfolio risk. Yeah, I think that's pro-cyclical assets. I guess that means market timing. So, whatever. It's not something I do, and it's apparently not something they recommend. They just say how awful it is. Next quote. Reducing exposure to equities and bonds to accommodate non-correlated assets or alternative strategies may reduce risk, but at the expense of lower potential returns and painful tracking error. So, if you don't do bonds and stocks, but do uncorrelated assets, often called alternative assets, which I'm not even a big fan of, they're saying that you're likely not to match the S&P 500 or the total stock market and just end up with lower returns. I think that sounds right to me. Wait, am I agreeing with something? Okay, I continue. Quote, we introduce a novel investment concept. Pause quote. Okay. Regular listeners to the show know, I hope you know. If not, I'll make it clear here. I'm not really cool with new ideas and new trends at how to invest. Not that they're wrong by being new, but there's hundreds and hundreds of new ones. How do I know? How do you know which one of the new ones is actually good and which ones are bad? So I don't want to kind of roll the dice to make a whole lot of money. If I can make a pretty good return and save a generous amount of my income every year, you're pretty likely going to end up being rich. It just takes time and it takes work. But if you want to do the quick and easy, maybe one of the new ways can work for you, and maybe one of the new ways can wipe you out. And you have to start again and try quick and easy again, because the past few times you tried quick and easy didn't work. Okay, let me start over. We introduce a novel investment concept accessible to all investors, which is designed to seek higher returns with less risk and low tracking error by using new products, which in combination can provide more than $1 of exposure for every dollar of invested. So the end here is the important part. More exposure than $1. So they're talking leverage. So I'm not cool with that. Leveraging historically has not worked. So it's not going to work. It creates opportunities for increased taxes, increased expenses, volatility, risk, all of this while claiming to make higher returns than just having the stocks, which they were already concerned with that might be too high. Okay, I continue. The proposed solution harnesses the full potential of traditional portfolios, plus the opportunity for higher returns and risk reduction from non-correlated investments. All right, I got the idea. They have a lot of big words. They like to use a lot of big words. They're probably going to use some hedging, some leveraging. They're taking risks that aren't risky bonds, so they're doing something different. Is it more risk than you want? Is it less risk than you want? I don't know. How are you going to know? So just for fun, I pulled up this fund, one of the funds I found in Morningstar. And anyone can do this, Morningstar.com. The fund that I happened to look up was RDMIX. RDMIX. curiously, at this moment in time, it's sitting on 88% cash. So I guess they're not really doing anything at this point in time. The funny thing is the expense ratio is over 2%. Over 2% to have 88% of the money sitting in cash. 12% was in bonds. So they have no stock investments. They don't even have alternative investments, at least how the data is structured and laid out at Morningstar. It looks like they're just sitting on a giant pile of cash right now and charging you 2% for the privilege. And it makes me think that maybe there is a way to make more money than starting a religion. I should start a mutual fund and just charge people 2% to sit on cash. That sounds freaking awesome. Matter of fact, I can stack their returns by investing their money and still paying just 2% while I use the money for something else. Anywho, the performance data for this fund, again, the fund is RDMIX. Year to date, calendar year 2021, has made almost 15%. That's compared to 20% for the Vanguard Total Stock Market Index. So you've lost 25% of your return. That doesn't feel very stacky. I'm not getting stock market returns plus, so I'm taking more risk, higher expenses, and getting less for it. But here's the funny thing. In a given year, this scheme that they have may or may not work. So let's look at the long term. This fund has actually been around for more than 5 years. And the 5-year return is 5.06%, which if you compare it to the average 10-year stock return, it's half. But the last 5 years have not been average. The last 5 years, the total stock market index fund, as measured by Vanguard's fund, VTSAX, is 18.2% per year. So this fund that's stacking returns and beating the stock market by being clever and uncorrelated is returning 5% per year versus the 18.2% per year, which already did happen. Who knows how it's going to work in the future, but the track record of the last 5 years is devastatingly awful. You're paying a lot of money in expenses. I'm sure they're trading like crazy. So if you have this in a taxable account, you're going to have a larger than desired tax consequence. And the results are abysmal, but yet here they are promoting it. And I'm guessing it's because they can make 2% off of your money while providing you, nothing. I mean, less than nothing. It's worse. Anyway, so that's just some thoughts on, what did they call this? Return stacking. If I'm missing something, if somebody sees something, if the original author of this email sees something that I'm missing, let me know. I can take a look at it again. But what I found with a quick review is not impressive. Once again, thank you for listening, and I'm delighted that you have joined us today. Hopefully you enjoyed the Investing Skeptically segments. If you have other ideas or questions, something that you've seen, something that you're curious about and want me to take a look at it, you can send me an email, phil@polarisfinancialplanning.com, and I'd be happy to take a look at it. Just keep in mind that if you send me something and I don't cover it, it's nothing personal. Right now, people are sending me more ideas than I can do segments on, so that's kind of cool. But otherwise, things are going great. It's a beautiful fall day here, and I think I'm gonna, after I wrap this up, go mow the lawn. It's really nice looking outside, and I do hope to see you out there on the road somewhere in the future. Until then, ciao.
Working Christian style. Christian style. We are disciples of Christ and we aren't afraid to show it. We love Jesus Christ and we want the world to know it. The Great Commission tells us to go into the land, meeting people on the street and offering up a hand. Out here in the world,
buying people coffee,
out here in the world,
shoveling people's walkways,
out here in the world,
watching kids for date night,
out here in the world,
gonna make it right.
showing kindness, so important to me,
Hey!
and to you.
Hey!
It shows the world that Jesus loved them and that he died for you and me. And when we share the love of Christ, oh yes, we share the love of Christ, we are free, 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 free.
Working Christian style.
Christian style. Work, work, work. Working Christian style. Christian style. Work, 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 work. Working Christian style. Hey, there's a lady. Work, 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 work. Working Christian style. Hey, let's help that lady. Work, 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 work. Working Christian style.
They're setting up tables or greeting at the door, helping out in kids' church, scraping gum up off the floor.
We're helping out at Christmas, making lots of Christmas hampers. We fill them up with turkey bread and lots of babies' Pampers.
We love to help a friend in need by offering up a meal. It's all about showing all that God's love is real.
We're helping out a single mom by taking out her son so she can go shopping or get her nails done. Showing kindness, so important to me,
Hey!
and to you.
Hey!
It shows the world that Jesus loved them and that he died for you and me. And when we share the love of Christ, oh yes, we share the love of Christ, we are free, 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 free.
Working Christian style.
Christian style. Work, work, work. Working Christian style. Christian style. Work, 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 work. Working Christian style. Hey, there's a lady. Work, 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 work. Working Christian style. Hey, let's help that lady. Work, 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 work. Working Christian style.
Showing acts of kindness is who we're meant to be. So now you see evangelism ain't so scary.
Now you see it's easy. Get out and get it done. Share the love of Christ. It's your turn. Pass it on.
Working Christian style. Hey, there's a lady. Work, 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 work. Working Christian style. Hey, it's that same lady. Work, 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 work. Working Christian style. Working Christian style.